This video is aimed at providing viewers with an overview of Treasury regulations. The PFMA states that the National Treasury must make regulations or issue instructions applicable to departments and outlines areas that the Treasury regulations must address. Therefore, the Treasury regulations are seen as an extension of the PFMA. Applicability of these regulations. Any reader of these regulations must familiarize themselves with the applicability section, since it outlines which aspect of the regulations applies to the different types of government entities. The application is as follows. Departments, Regulations 1 to 24 and 26. Constitutional institutions, Regulations 1 to 22. Schedule 2 public entities, Regulations 612, 24, 25, 27 to 29, and 31 to 33. Schedule 3A and 3C public entities 612, 16, 16A, 24 to 28, and 30 to 33. Schedule 3B and 3D public entities 612, 16, 24, 25, 27 to 29, and 31 to 33. SARS 612, 16, 16A, 24 to 28, 30 to 33. This principle is also outlined in the PFMA, where it was discussed that one must understand the types of public entities that are in the schedules of the PFMA, as this determines which of these regulations apply to different types of entities. Regulation 3, titled Internal Control, is applicable to departments and constitutional institutions only and is summarized as follows. This regulation outlines the requirements of audit committees and makes reference to shared audit committees where applicable, which will be at the discretion of the relevant Treasury. Shared audit committees relate to one audit committee having its legislated oversight and governance to more than one department or constitutional institution. In cases where audit committees are not shared, the accounting officer must appoint these members in consultation with the executive authority. These regulations also outline the requirements of an audit committee as far as its composition is concerned, as well as indicating the authority that the audit committee has. Audit committees must be constituted so as to ensure their independence. The audit committee must, amongst others, review the effectiveness of the internal control systems, the effectiveness of the internal audit function, the adequacy, reliability, and accuracy of financial information, the institution's compliance with legal and regulatory provisions, and the activities of the internal audit function. Internal controls and internal audit stem from sections 38 and 76 of the PFMA. This regulation places a requirement on the accounting officer to ensure that a risk assessment is conducted regularly and places additional requirements to have a risk management strategy and fraud prevention plan in place, which must be used to direct internal audit effort. There must be an internal audit function. The internal audit function must prepare in consultation with and for approval of the audit committee a rolling 3-year strategic internal audit plan, as well as an annual internal audit plan. The rest of the regulations in this section indicate areas of focus for internal audit. Regulation 5 relates to strategic planning, which applies to departments and constitutional institutions. The accounting officer of a department and constitutional institution must prepare a strategic plan for the forthcoming period for approval by the executive authority. That strategic plan must, amongst other requirements, cover a period of 3 years, include specific constitutional and other legislative, functional, and policy mandates that include the output deliverables, and include the measurable objectives, expected outcomes, program outputs, indicators or measures and targets of the institution's programs. The strategic plan must form the basis for the annual reports of accounting officers. The accounting officer of an institution must establish procedures for quarterly reporting to the executive authority to facilitate effective performance monitoring, evaluation, and corrective action. Regulation 6 refers to budgeting and related matters. The budget requirements as well as formats and the reporting requirements as well as submissions are outlined. National Treasury determines the formats of annual budgets. The budget adjustment process, known as virements, provides specific instructions and approvals and timelines around this process. A virement refers to the process of using savings within a division in terms of the budget and allocating the savings to another division. There are specific rules around these processes. Regulation 6.4.1 deals with unspent funds from a financial year and the conditions it can be rolled over, as well as the approval process. A rollover refers to a process where funds are not spent in a particular year and may be rolled over to a subsequent year, subject to approval of the relevant Treasury. Part 4. Revenue and Expenditure Management. This part, as the name suggests, deals with the revenue and expenditure management. Part 4 includes Regulation 7, Revenue Management, Regulation 8, Expenditure Management, and Regulation 9, Unauthorized, Irregular, Fruitless and Wasteful Expenditure. Regulation 7, Revenue Management. This regulation is applicable to departments and constitutional institutions. The regulation applies to the identification, collection, recording and safeguarding of all revenue for which an institution is responsible. The accounting officer of an institution must manage revenue efficiently and effectively by developing and implementing appropriate processes that provide for the identification, collection, recording, reconciliation, and safeguarding of information about revenue. Regulation 8, Expenditure Management. This regulation is applicable to departments and constitutional institutions. Regulation 8 requires the accounting officer to ensure that there are internal procedures and controls in place for payment approval and processing. The principles around the approval of expenditure are also outlined. In general, all payments due to creditors must be settled within 30 days from receipt of invoice. Regulation 16A relates to supply chain management. Note that this regulation applies to departments, constitutional institutions, Schedule 3A and 3C public entities. Supply chain management refers to the process, legislation, and regulations that apply to the process of how goods and services are sourced in the public sector. The accounting officer or accounting authority of an institution must develop and implement an effective and efficient supply chain management system for the acquisition of goods and services and the disposal and letting of state assets, including the disposal of goods no longer required. It should be noted that this regulation provides the framework for a supply chain management system. The system must be fair, equitable, transparent, competitive, and cost-effective. Note that these principles are also outlined in Section 217 of the Constitution. This regulation also outlines at minimum what should be included in the supply chain management system, such as demand management, which relates to the process around planning for the organization's procurement needs for the financial year. Acquisition management. This relates to the processes around the actual acquisition of goods and services and the related controls around these processes. Logistics management relates to processes around controls of the transport of such goods and services where applicable. Disposal management relates to the processes and controls around the disposal of any state assets, risk management, and regular assessment of supply chain performance. A supply chain management unit must be established within the Office of the Chief Financial Officer to implement a supply chain management system. Procurement of goods and services must be done either by way of quotations or through a bidding process and must be within the threshold values as determined by the National Treasury. The National Treasury practically implements this regulation by issuing SCM instruction notes that outline what these thresholds are. Currently, SCM Instruction Number 2 of 2021 to 2022 is the relevant instruction and in summary states that expenditure with an estimated cost of up to 1 million rand should go through a 3-quote process. Items above that amount should go through a tender process, also referred to as a bidding process. Viewers can obtain a copy of this instruction from the National Treasury website. A supply chain management system must, in the case of procurement, through a bidding process, provide for the adjudication of bids through a bid adjudication committee. This committee makes a final decision regarding the winning bidder from a procurement process and ensures that all processes outlined in legislation have been followed. The establishment, composition and functioning of bid specification, evaluation and adjudication committees, the selection of bid adjudication committee members, bidding procedures, and the approval of bid evaluation and/or adjudication committee recommendations. All officials and other role players in a supply chain management system must comply with the highest ethical standards. Part 7. Accounting and reporting requirements. This part applies to departments and constitutional institutions and includes Regulations 17 and 18. Regulation 17 covers basic accounting records and related issues. All transactions of an institution must be supported by authentic and verifiable source documents clearly indicating the approved accounting allocation. Controls must be in place along with timing limits with regard to the exceptional case of the use of suspense accounts. The requirements for the availability and storage of financial information are also outlined. Regulation 18 deals with monthly and annual reports. In addition to the reporting requirements of Sections 40, 4, B, and C of the Act, the accounting officer must also comply with the reporting requirements of the Annual Division of Revenue Act. The objective of this Act is to provide for the equitable division of the revenue raised nationally among the national, provincial, and local spheres of government. Specific reporting requirements are outlined with regards to the contents of annual reports over and above the reporting requirements of the respective financial reporting accounting frameworks. Some of the items required to be reported are information about the institution's efficiency, economy, and effectiveness in delivering programs and achieving its objectives set out in their strategic plan. A report from the audit committee is also required. The department's annual report must also include a list of trading and/or public entities controlled by or reporting to the department. Part 9 of these Treasury Regulations deals with public entities. Regulation 26 deals with the quarterly reporting by the accounting authority of a Schedule 3A and 3C public entity. The public entity must report quarterly to the executive authority on its actual revenue and expenditure for that quarter, as well as projection of expected expenditure and revenue for the remainder of the current financial year, as well as the extent of compliance with the PFMA and related regulations together with the reasons for the non-compliance. Regulation 27, Internal Control and Corporate Management. This regulation is applicable to all public entities, irrespective of their listing. Audit committees, as well as their composition, are indicated. The audit committee must be a subcommittee of the accounting authority. The chairperson must be independent. The majority of the members must be non-executive members of the accounting authority. This regulation, specifically 2718, outlines that the audit committee should at least review the effectiveness of the internal control systems, the entity's compliance with legal and regulatory provisions, and, where relevant, the independence and objectivity of the external auditors, amongst other items. The requirements of the internal audit function is outlined and is similar to that as required for departments and constitutional institutions. Regulation 28 deals with the annual financial statements and annual reports for all public entities. Specific disclosure items that public entities must include in the financial statements are outlined. The annual financial statements must include a report by the accounting authority, which must include disclosure of the remuneration of members of the accounting authority, CEO, CFO, and persons in senior management. The accounting authority must develop a framework that defines materiality and significance relevant to the public entity, and this must be agreed to with the executive authority. This is needed to address reporting requirements in the PFMA that refers to material or significant. Thus, where a public entity must report or seek approval or disclose a material transaction or a significant transaction, this materiality and significance framework defines what is considered to be material and what is considered to be significant for that public entity. This would be specific to that public entity. Regulation 29 deals with corporate planning, shareholders' compacts, and annual budgets for Schedule 2, 3B, and 3C public entities. The shareholders' compact refers to public entities that are companies and must include its strategic objectives and outcomes, which must be agreed on by the executive authority. The corporate plan and shareholders' compact basically serve as the key performance indicators of the public entity, as agreed with the relevant minister. Regulation 2911 states that the corporate plan must cover a period of 3 years and details what the corporate plan must include, namely strategic objectives and outcomes, strategic and business initiatives, key performance measures and indicators, a risk management plan, a fraud prevention plan, a materiality and significant framework, a financial plan which includes various projections. Please view the other episodes in this series to gain a better understanding of how the public sector finance operates. In our next episode, we will be discussing the MFMA.